Guys, how are you? This is me, the Market Sniper, coming at you on equities today. Equities and indices. I haven't done the indices in an age, and actually we've been talking a lot about it in our premium community. And as much as we are the reset sniper, we've been bullish indices generally. There are a few industries we've been bearish on that I've spoken about specifically, like oil, subprime cars, which is both a combination of banks and cars. But overall, the indices, particularly the damn FANGs, Microsoft and the likes, are very, very powerful. There are going to be quite a few $trillion market caps building up of the big majors. They've been super, super strong. And you might be saying, well, why is this fundamentally? We'll talk about the chart that I've put in front of you right now. But why is this fundamentally? And in fact, before I even say anything fundamentally, click the link to like, share, and subscribe if you haven't already done that. Bell for notifications. Let's get into those fundamentals. So fundamentally, essentially, we are creating so many bonds, so much government-based debt. There's an almost unending supply of it being created. Money is being created. That money needs a parking place. The rate of return that's being paid on that money is absolutely pathetic where it's positive, or it's zero or even negative. Bear in mind, the bulk of Western Europe is paying zero or below zero rates on bonds. So what you actually have is a situation where there is no positive yield on big parking bays for money, and money being created at an ever higher rate, at very higher rate as in quantity, and at much lower interest rates in terms of debt. So corporations have been borrowing, retiring equity, etc., etc. Anyway, let's look. So that's some of the reasons why you have this absolute perversion. Of course, equities, by all forms of measure, are at unparalleled highs. We're just about to hit the 2000 highs on relationship of revenue to valuation of companies. The last time it hit this high was 2000. And everyone will go, that's it. It means an immediate crash. And I'm sorry to say it doesn't. It means it's probably going to go higher first before we get to the point where we crash. And that could be 2 years out for all you know. As I've said, still backing on the Trump re-election and then crash it on the conservative white antagonist president, as they did with Bush. But that's still some way off. You know, it won't happen immediately as he gets re-elected. That election's only in 2020, at the back end of 2020. It'll probably roll it, you know, things will start to fall apart. It'll roll into 21, 22. So, you know, the big all fall down. Yes, there will be fear. Yes, there will be a 2008 liquidity crisis problem reaction solution, in my view. But, you know, there's a couple more years potentially in that, or certainly 18 months, and a lot can happen in 18 months. So let's just do quick history of the equity markets for those that are new. Essentially, the 60s, after you got into the 60s, were a terrible time for equities. Okay, largely you were bouncing around, going nowhere fast, and only the killing of the inflation, that of the dreadful stagflation that coincided with the 70s and into the late 70s and early 80s, where the last semi-serious Fed, Faulkner, actually raised rates to kill inflation and took the punch bowl away. Last time someone took the punch bowl away, Faulkner there. And the man who came in his place was actually Greenspan, round about here. And then he was Mr. Liquidity King. And I've put this in a log scale. In other words, it's worked as per percentage. If you want to have a look at this chart to see the extremity of the move that subsequently occurred after the major tightening of interest rates that broke the inflation back and saw bonds at their lowest value paying the highest yield, you then flipped into this huge bond market bull that literally hasn't ended and started in 1982, which was the point roughly where this breakout of our pink box started for the final time before breaking out the range. So let's just show you that chart in a non-log sense so that you can get a proper look at that for a hockey stick, guys. Look at that for a hockey stick. I'm putting it in log scale just to give you some sense of proportionality over here. So it's percentage of moves. By the way, 1987, which is when I entered the market in August in time to catch that crash. How about that? For a random reward monkey myself. There's nothing more than a mid-market correction in a bull market that started literally from the late 82 right the way up to 2000. That's right, 18 years. You just had to be largely net long, and you would have only had one really bumpy year and a bit, and it was quickly fixed. And that was the bull market out of the stable period of the 70s, the stagflation of the 70s. Then we had our bouncy period again. That was from 2000. So that was 2000 bust, the dot-com bust. Some recession here for the US, 2 and 3. Then you had the reinflation that Greenspan brought, and then you had the 08 bust, that's around about here, 08 into the lows of 09. And essentially you had all the way up till around about there. It wasn't till about 14, 15, around about beginning of 14, that you actually took out the highest point just prior to the housing collapse. And throughout that period, largely you were in a rally, dump, rally, and there was quite a bit of money created as part of QE that came in from here. So the dollar here was not the same by any means as the dollar down there, as we proliferated through the Fed, etc. So let's take some of those lines off. Now I'm going to talk slightly more technically, and I'm going to get a little bit in the front. Now you're going to need to be in our premium community to learn about what this broadening pattern is. Some of you will go megaphone, that's fine. Most people don't know much about a megaphone and how to trade it, and you're welcome to Google it, and what you'll find in the internet is very disappointing. Register below for our mini series, by the way, for some free info. In our premium area, you'll learn all about broadening patterns and how we trade it. But this, I will tell you, actually on the big time frame, although it involved two huge crashes, but the overall structure viewed from a super macro point of view is one long bullish continuation. But not every megaphone is a bullish continuation. You'll learn how we differentiate. It's part of our theory that is unique, and we are the specialists in volatility tightening patterns, and now we've added volatility broadening patterns to that. But anyway, it set up the major bull market that was that bull market. So I'm going to take it back out of the logarithmic sense just to give you the fact that there was a real bull market in that, and you can see from the 2009 lows. Whoops, let's not hit the menu item. Let's go back to draw mode. From the 2009 lows, you had an amazing run up to the 18,000 from not much above 6,000. How about that for a little 3x? And that's just in the general index, guys. Now, you've also got to remember that 84% of America only holds around 16% of the equities. So you've got the bulk of the wealth is being made by roughly 10 or 12% of Americans. So the wealth factor of the equity market is exceedingly narrow overall when compared to the general market. And I want to say America has a culture of equities where they own it. People talk about stocks over there. Your taxi driver might have an opinion. In other European countries and other places, there's even less of a culture. So the equity boom is helping call it the 1%ers, the 5%ers, the 10%ers, whatever you like. Anyway, so that was a continuation pattern, and so you continued on up. And I want to then say this bull market was very, very stable. You had a bit of a top out there in 11. 11 was a bumpy year, and you came back, and then you continued to grind up. Guess what? You've got another form of broadening pattern over here again, and many people called for heads and shoulders, perpetual bears, and unfortunately in this QE-based world, currency destruction world, anything that forms a yield will continue to rate upwards. Anyway, that pattern, and you'll learn again, as I say, why we called that a continuation pattern in time, because not all broadening patterns are, and we teach you which ones are and aren't. In fact, many of them are topping and can be reversal. And then you ended up getting this substantial move. So you ran from the 15.4s all the way up to the highest point in the megaphone over here, 27,000. So the lowest point at 15 to 27,000, you're almost another 2x in there. And it came quite a bit quicker. So that was 2016. China wet the bed and was totally over indebted. The QE printers came out in time again, and that took us up to this point here. So we've been getting repeated QE and currency devaluation, which pushes stock markets up. Even if they're ridiculously overvalued, they yield something positive in their earnings. And that's just stretched valuations to all-time highs, and it can continue as long as they keep destroying money at an extreme rate. So what's happened now? What's happened now? Let's bring this to the current, Francis. Why have you been bullish recently in your premium community about the indices such as the Dow and the S&P? Okay, well, let's drop it down and take you into the here and now. Again, broadening pattern, again, a megaphone. Again, you'll find out why this one was a bullish one. As I've already said, you get bearish as well. You could see you clustered up against there. I'm giving you a little bit of an idea of a fractal in there. I'm going to take the eye off now. In that fractal is an upside HVF for which there was a target, and of course you were bumping against the top end of your megaphone, waiting the breakout of your upside move against your megaphone, and you go and form a HVF fractal with an upside target which will take you up through that. And I can report we're not too far away from making those targets. What will happen? Everyone can't bear this hyper move that on the weekly chart looks like it's just gaining momentum. They're going to buy at any cost now, and what will probably happen is we'll finish the HVF target and we'll have a dip back down to that megaphone grind line. So the people will chase in always at the top. That's what they do, and the target will down. They might get shaken out before we will continue on up, as we continued on up as we came into this structure, which was broadening. So you've actually had three separate broadening patterns, and if you think that's unique to the Dow Jones Industrial, let me just say to you, you'd be wrong. I'll do a quick flash buy on the SPY, and you will see the exact same thing, and I will put it also on the monthly. In fact, there it is on the weekly with structure. I'm going to remove the scribble now. Give me a second, and if I take the eye off, you'll see those same broadening patterns were forming way down here, there, and of course across here as well. So Trading Views having a little bit of a clever moment there, leaving weird lines all over the place, but there you go. Again, very, very similar bull market, very similar. So this is a SPY. Both of these are indices, and you can see up top that we've got our targets for upside, and that those are well on the way to being met. So it's a bull market. It's the most hated bull market, and you are squeezing up. Long and short of it, though, that there is a little bit of rising wedge structure in this, so you'll melt out the top, and there will be a point where it slows down, because the exuberance of the equity market also becomes a problem for the Fed. They'll start talking tough again, pretending to raise rates again, only not, but talking tough, or slowing down the implied rate of rate cuts, just to curtail the rate of increase on the equity market. That's what they do. That's the games that they play. These are your central planners managing asset values for the benefit of their audience at your expense, because they devalue your money to pay for the wealth created for all the equity class. So again, you can see upside structure for an HVF in there that's close to being made. Good. A couple of things else that I can say to you. Well, Microsoft, for example, I mentioned one of them, quite cash generative company now. Fell out of favor for a while, but it's actually making a lot of the good moves. Similar type structure again, you can see it. There you go, just made target today. Probably going to overperform a little bit with the upside. Again, upside structure much like the SPY. So these big cash generative unicorn tech, Alphabet, Amazon's been a little bit set apart, but I think it will wake up and play catch up as well, are going to continue to be hyper valued control structure mega corps that pay little tax, especially well looked after, lobby like hell, and get away with murder, and also have a whole bunch of cheap money to buy their own equity up and drive valuations well beyond what you think should ever occur. So trade what you see, not what you believe, guys. Too many of us get stuck in belief systems and we only want to short. As I've said, there are industries where I am short in, but even the financials were wrong wells, they've re-pumped up. We all run the risk of being overly bearish. The stock market is not the economy, and the economy is not the stock market. And as long as they're creating easy, cheap money at record rates, it's got to get a parking bay somewhere. And one of the few places where you get upside returns, ETFs are just piling in, robot buying all the majors. So that's a steady supply that continually has to reinvest. Monthlies are paying into that, and they're overperforming. At some point, however, there will be a reckoning day, both for the ETFs and these indices and the overvaluation. And I think it will be part of our reset. The next time we have a major liquidity crisis, everything will wet the bed. That said, stocks will probably rebound because the solution will be QE, in much the same way that I expect gold to do well on QE and is currently doing well. That's a little flyby by the indices. So I want to remind you of something else. If you enjoy what we do, book in to have a chat. It may well be for you, it may well not be, but you will talk to an experienced HVF trader and you can ask him about his experience. You'll be able to hear more about how we help deliver. We have both amazing app. Interactions are like looms, much like this video, for example, only sometimes more trade specific details with all the lines and levels there. Full training, which we've just probably close to completing the first leg of re-recording to a highly modern standard with really great HVF content. I saw one guy say, oh, you know, I was looking at another program and you were expensive. No, you weren't. There is only one place you get HVF method. It is far superior to traditional technical analysis, moving average crossovers, pivot levels, trying to make a trade purely on Fibonacci's. You get your stop placement, you stay there, you get your triggering tripwire entry, and you get your targets with every trade, and you can walk away from the screens, and you can get high reward to low risk trading. If you understand the value of that, you will not be comparing us with other programs or costing, and there are low cost get started packages also available for those at a lower level, which are self-study as well. So find out about all of that by checking in for a chat on the call below. Like and share if you've enjoyed the video, and maybe we can do more on indices and equities if you enjoy that and you'd like to hear more. Thank you for watching, and we'll catch you all soon. I'm Francis, the market sniper, the crypto sniper, and the great reset sniper. Bye for now.